Hey friends, I only have so much precious capital, and when I invest that capital, whether it be in dividend paying stocks or in real estate, I am really focused on getting all of that original capital back. I'm especially thinking about this concept these days because I'm in my 40s. When I was younger, when I was in my 30s, my 20s, and I was investing in dividend growth stocks, I would typically pick those stocks like SBUX that have a low starting yield, but they're increasing the dividend very quickly each year. These quintessential classical dividend growth stocks over very long periods of time offer enormous yield on cost. I'm going to share some models about that in the video today, but I want to talk about why I'm thinking a little bit differently these days. Of course, I'm always investing in core companies, but as I get older, this concept of having many decades for yield on cost to work just doesn't exist. I'm older. I want to tap into cash flow quicker. And so I want to share a video today for those investors who are in their 40s, 50s, 60s, 70s, maybe 30s too. But some of the younger viewers out there, I think you'll enjoy this as well because it gives a preview of what's to come. I want to just start off with a simple concept that right now, when I am deploying money in the stock market and I look at how many years I really have ahead, I don't want to invest, typically speaking, into stocks that have such a low starting dividend yield that when I sum up all the future yield, all the future distributions, I won't get back my capital invested in my lifetime. Now, of course, there's an element of investing when I invest that I'm looking towards my kids, towards future generations. That being said, I'm in this for me. I want to enjoy the cash flow, the dividend distributions during my lifetime. So of course, if I were to sum up all of the future distributions for any given position, and I'm not even going to make back what I put into it during my lifetime, that's a little bit too long of a horizon for me at this point in my life because I just want to tap into those dividends. Now, if you're trying to run at home a quick back of envelope calculation, all you have to do is look at the current dividend yield of the stock you're investing in. If you take 100 and then you divide it by that current starting dividend yield, the result will be the number of years it will take to get your original investment back. Now that assumes no dividend growth, so it's a conservative back of envelope analysis, and it's just a starting point to understand how many years it might take to receive back all of the capital invested. Now, many of you know that recently I increased my position in Realty Income by more than 50%. The reason that I did that is I was able to deploy most of the capital when yields were around 6% on that stock, which is a great starting distribution yield on that REIT. And I ran the very math that I was just discussing, but a little more complex. I'm going to show you my model in a minute. And I was running that, and it looked pretty reasonable to me that I would get my investment back in a reasonable amount of time, and I would have many decades on top of that to enjoy all of the gravy, all of the cash flow after getting that principal back. I want to frame the video today just through a real estate mind space, kind of how real estate developers look at the world. And I'm applying that in many ways to dividend investing in the video today. So I'm also a real estate developer, and the life cycle of the real estate developer goes a little bit like this. Now I'm simplifying quite a bit, but I want to do this to illustrate a point. And so real estate investors will go out, they'll find a property, they'll want to develop that property, and the first thing that will happen is, hey, we got to raise some capital. Usually it's going to be the developer himself or herself putting in money into this particular deal. And so that capital, along with the partners, the business partners, their capital, will be able to go out and not only purchase the piece of property, but will be able to go out then and develop some plans and some dreams, share that with a lender such as a bank, and get a construction loan. Once the construction loan is produced and it's secured, then the real estate developer can go out and construct the facility. And once the facility is constructed, it goes into lease up mode, and the developer will typically hire a operations partner and will lease the thing up. Maybe it will even be able to increase the rental rates over time, and that at a certain point, that property will be profitable, it will be doing really well, it will be surpassing its marks, surpassing the projections, and it's really at that point that what happens is there's a refinance, and that construction loan is refinanced into a permanent loan. And typically at that time, with a really good real estate developer, with a really good product that was built, that permanent loan will no longer have recourse. And what's great is at that time, typically the value of the real estate has grown quite a bit, and it's because the development process has created value. And the value that's created is evident that when it's refinanced, the valuation is higher, and typically those investors are able to take cash out of the deal as part of that refinance. And oftentimes when that cash is taken out, the original capital that was invested, it's returned back to all the investors. Sometimes even more than that, but at least the original capital that was invested. Now, after that, the real estate will throw off cash flow, and the investors will get an increasing income stream of cash flow, just like dividend stocks in perpetuity. But as long as it's managed really well. The difference here with how real estate investors oftentimes look at deals versus dividend investors is it's that key inflection point around the time when the permanent loan refinance happens that the capital is returned to investors. And that's really important, because most real estate developers, they only have so much capital. Sure, a successful developer can do really well, but capital is important. Investors want to hold their capital closely, and they want that capital returned so they can go out and do another deal. And they can do another deal and another deal. And so that capital is really precious. And oftentimes, developers only want that capital in that deal until it's refinanced. Now, of course, there's other benefits to real estate investing and development, such as depreciation, and especially the accelerated depreciation that's been on the tax guidelines as of the last few years. Also, what I would say about real estate investing is it carries a ton of risk. Single property, lack of diversification. There's a lot that can go wrong between the time a construction loan is taken out and one is able to refinance and it reaches a good point. We could see interest rates spike like they have now. And these high interest rates, they're breaking a lot of real estate models. And you've even seen this with REITs. REITs have fallen in share price because there's a lot of sensitivity between real estate and interest rates. And so there's a lot that can go wrong. And dividend investing, in my humble opinion, is a much safer route of capital allocation, although any investment carries risk. And this is not financial advice. I'm just sharing my personal journey here on YouTube for fun and entertainment. But I wanted to give that background in real estate because it takes me to this point about dividend investing, that these days, especially being in my 40s, I'm kind of looking for, just like I do with my real estate development, I want to look for that getting my capital back event with dividend investing. Now, dividend investing doesn't carry that refinance event, and so I wouldn't get all my capital back at once, but I'm getting back a little of it each year, each quarter as I take distributions, and with Realty Income every single month, actually. And so as I don't reinvest on some of my holdings, and I take that cash flow just as that to pay bills, that is a form of cashing out. And so I want to share on the screen with you some models. Check it out on the screen in front of you right now. So the first model that you see there actually is Realty Income. I've been buying a lot of this. My patrons know. Check out the pinned comment below for a link to my Patreon where I share my stock trades. And you can see now it's climbing up to $54.13. I'm still a buyer below $55, but I liked buying a lot more when it was at $49, $50. Still down 21% from the 52-week high. I still like the starting yield of 5.68%, but not as much as 6%. And I love the valuation. I'll say on an AFFO, adjusted funds from operations basis, the interpolated PE there is about a 13.67, using the AFFO, taking that as the denominator. And so I like it. What I would also say about Realty Income is their dividend growth rate on average is 3.03% per year. In perpetuity, I think that is pretty steady. That's a pretty steady rate of kind of increases, if you will. I would say that would tie back to my experience as a real estate guy as well. That seems like, no, that's not too high. They can keep that going in perpetuity, and maybe they can even notch it up a bit. But what you see, that's just the left-hand side of this screen. Okay, I love it. Great starting yield, taking those dividends, using them to pay bills. Now, one of my subscribers was asking, Ian, are you using all of your dividends to pay bills? No, I'm still reinvesting in my core stocks and some core plus stocks as well. SBUX, for example, and the likes. Those are still reinvesting. I'm delaying gratification. I'm delaying tapping into those dividends to pay bills. But with some of my stocks like Realty Income, yes, and especially ancillary positions as well. But as you can see on the screen in front of you on the right-hand side, I want to share this fun model. So this model is kind of similar to the equation I shared earlier on in the video, but it's a little more advanced because my equation earlier on in the video did not take into account dividend growth. But we know with the best quality dividend growth companies that dividends increase year by year. And it's 3.03% on average for Realty Income. And so let's just say I invest $1,000. I'm taking all my dividends as cash. I have a 3.03% dividend compound annual growth rate. How many years would it take for me as an investor to get my capital out of Realty Income so the rest of it is just gravy? That is precisely what the model shares on the screen. And so as you can see, first year, I just have a total amount invested of $1,000. Second year, it's the same. I'm not investing more. I just invested $1,000, one and done. My yield on cost in the first year is 5.68, but it goes up in the second year because we know they increase the dividend on average per year by 3.03%. And that's why that yield on cost goes up. And that's why my cash flow goes up, because the cash flow is simply the amount invested times the yield on cost. And you can see I have a cumulative cash flow there as well. Really what I wanted to see is, hey, Ian, I invested $1,000. How many years is it going to take me to get all that money back? When is my complete, if you will, cash out kind of refinance event, permanent loan event happening, if you will, for this particular investment? And what I found is it's around years 14 or 15, somewhere in the mix. That's why I highlight those in yellow. And you can see by then my yield on cost is up in the 8+% range. You can see at the bottom of the screen after 30 years, my yield on cost goes all the way up to 13.5%. Now, of course, if I were reinvesting dividends on this, my yield on cost would go up even more because it would be a more powerful snowball. But I'm in my 40s. I'm taking dividends. I'm looking at things a little bit differently now, and I'm trying to illustrate today a different perspective for those investors that are in their 40s, in their 50s, in their 60s, who want to look at this a little bit differently, want a new angle of kind of making trade-offs in the financial portfolio. And I'm going to leave the video today actually why I started thinking of this, kind of the big epiphany or just the big question I had, why I need to look at it this way, in addition just to the classical kind of dividend snowball way as well. But before I do that, I want to talk about SBUX because it's a way to look at this differently, because SBUX is very different than Realty Income. As you can see on the screen in front of you, SBUX is a classical dividend growth stock. This is one that has a very low starting yield. It is super low at 2.23%. And we know, however, that they're increasing the dividend on average by 9.6% per year, although the last increase was lower. And so as I project this one out, I don't think 9.6% per year is sustainable. I think 8% is probably closer. So my model on the right-hand side of the screen has 8% instead of the 9.6 we've seen over the last 5 years. And we know the payout ratio there is 60%. You can see some of the metrics on the left-hand side. It's expensive as well, as dividend growth stocks typically are, with higher growth rates on the company itself, the earnings, the revenue, but also the dividend. Higher PEs are typically what investors see. But as you can see on the right-hand side of the screen, I've got the same model. Hey, I invested $1,000. I'm taking my dividends as cash. I've got an 8% dividend CAGR. How many years would it take? And we know by comparison that Realty Income took 14 or 15 years, which is reasonable to me. Getting my capital back in that amount of time as someone in my 40s. But you can see with Starbucks, you're looking more at 19 or 20 years. And so there's a good, say, 6 years more to get all of that capital back. Now, worth noting, all the way at the bottom of this thing, the yield on cost gets up to 20%, even over 20%, but we know Realty Income only got to 13.5%. And so I think one of the things that is really, really indicative of these type of analyses is for those investors that have a lot of time on their hands, many decades. Typically what I've found in the analysis is the dividend growth stocks are amazing. They're kind of the way to go, in my humble opinion, and that's how I looked at things as a younger investor. But these days, don't get me wrong, I've been buying some of my favorite core stocks recently. My patrons know that, and I am reinvesting the dividends because I do have a multi-generation timeline, and I'm staying really healthy. I've been exercising almost every day, and trying to stay in the game. But I also realize, hey, I am getting older, and so there has to be this element of thought of of getting that capital back. And here's where it gets. I don't think someone in their 40s kind of looks at things this way, but as I start getting older and I kind of look forward to my 50s and my 60s, what I started realizing is, hey, there's this comparable of an annuity model. Now, an annuity, typically what it is, it's a vehicle, it's typically an insurance vehicle that an investor can put their money in, and when they reach a certain retirement age, they can annuitize it. And when they annuitize it, the insurance money pays them an amount of money every month, typically for the rest of their life. Some of these annuities for the rest of the spouse's life as well. But when the investor dies, and when the spouse dies, in the case of the annuity that surpasses the primary annuitant and also goes on to the spouse, when those events happen, it's gone. All the money is gone. But with interest rates right now so high, I was just thinking in my mind, like, hey, Ian, you want to live life to the fullest. You want to start spending some of this money. You've been delaying gratification. You've built up a great dividend stock portfolio, a massive dividend stock portfolio. It's working really well. It's chugging along. You're still reinvesting a lot of the stocks, even though you're taking cash flow from others like Realty Income. But I'm reinvesting all the core stocks and then some. Ian, you've been delaying a lot of gratification, and there's things in life you want to do. And so I started thinking, like, Ian, boy, for net new capital, would I be better off as just taking it, putting it in like a high yield savings account, predicting how many years I have left in life, forecasting forward the interest I might get. Right now it's really high. It's probably going to go down over time, but I think it's going to be reasonably good interest rates for a while. And try to back into an annuity so that by the time I pass, I'm not talking about my dividend portfolio, I'm just talking about net new money, but I just kind of spend it. Instead of investing it, just spend a little bit each year. Now, of course, that would leave nothing by the time I pass, which would probably be just fine because I've already built this dividend stock portfolio, and perhaps that would give me more money to just enjoy things and go splurge, go after those luxuries right now. I am not there yet, but that was the thought question I asked myself that prompted the entire video today. And kind of what I realized is, no, I'm not going to change anything, but it's fun to think about these scenarios, and it's fun to have the annuity or that quasi-annuity in my toolkit because I can always do that on top of the dividend portfolio I've built. And right now, I'm not going all out on high yielders. I have a good balance of capital deployed going into stocks, or not stocks, stock. It's really Realty Income or core stocks. That's kind of where I'm at right now. I don't have any other high yielders I'm buying, but hey, I'm happy to double my Realty Income position from here if it remained at a attractive share price. And so that's the thought process I go through. I hope the video today was not too scattered all over the place. I had a lot of complex thoughts I've been having about this topic that I wanted to try to get out there into the community because I'd love to see your feedback in the comments section below. Let me know what you think. Are you a younger investor? Are you an older investor? Do you think about these types of scenarios? Do you think about how many years it takes to get your capital back? Do you think about altogether just letting the dividend portfolio do its thing and then having kind of the rest of the money you earn or you accumulate, just kind of divvying it up over the amount of years you got left and enjoying it and spending it and having more money? How do you look at those complex situations? I would love to know in the comments below. If you did enjoy the video today, please go ahead and smash the like button as well. It really helps me out. And please, of course, don't forget to subscribe. I have new videos on the way. I love you all. In terms of a full disclosure, I am long Realty Income, ticker O, and StarBucks, SBUX. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed financial advisor. I'm just sharing my journey here on YouTube for fun and entertainment. I'm not sharing investment advice. It's possible to lose money in the stock market, in the real estate market, certainly as well. And so please do go out and consult your licensed financial advisor before making any financial decisions. I love you all. I can't wait to see you in the comments, and I'll see you in the next dividend stock investing video. Bye.